Welcome to the Valuation Desk by Highland Global, where SBA business valuations speak bank. Thanks for being here. Did you know that restaurants forced to relocate due to lease issues are up to 10% more likely to default on SBA 7A loans within 2 years? Today we'll explore why relocation is such a valuation minefield and how you, as lenders, can navigate it. Let's start with the challenge of re-establishing a restaurant after a move. When a restaurant relocates, it's essentially hitting the reset button. It can take 6 to 18 months to rebuild clientele and stabilize finances, as seen with chains like Outback Steakhouse, which excludes relocated units from sales metrics for 18 months. Smaller independents might recover faster in 6 to 12 months or fail sooner without deep pockets. During this period, expect revenue drops of 20 to 40%, driven by lost customers and marketing costs to announce the new spot. Operationally, relocation takes 3 to 6 months for permitting and renovations, and any delay, say, in inspections, extends the pain. Even a 2-week closure can cost 10 to 20% of urban customers, who often defect to competitors. Imagine a restaurant's monthly revenue drops from $100,000 to $60,000 after relocation, slowly climbing back to $100,000 per month in about 18 months. As lenders, you'll need to ensure borrowers have enough working capital to cover debt payments during this dip. Now let's talk failure risk, which spikes after relocation. New restaurants have a 26% failure rate in year 1 and 59% by year 3. Relocated restaurants aren't far off, as loyal customers may not follow, and new demographics or competitors can disrupt sales. Forced moves like lease expirations are riskier than strategic relocations to high-traffic areas. SBA data estimates relocated businesses default on 7A loans 10% more often within 2 years. Why? Location drives 60 to 80% of revenue, so a site with less foot traffic or poor parking can slash sales by 30%. Financial strain, think lease termination fees or renovation costs, also raises debt-to-equity ratios. Zoning delays, which can add 5 to 10% to costs or push opening back by months, further tighten cash flows. For franchises, brand loyalty helps, but local traffic is still king. You should demand traffic studies and zoning compliance reports to gauge risk. So how does this affect valuation? Let's focus on the capitalization of earnings method. This method takes normalized cash flow and divides by a capitalization rate to estimate value. A stable restaurant with $50,000 in free cash flow and a 10% cap rate is worth $500,000 before any liquidity discounts. Post-relocation, uncertainty pushes that rate to 15%, dropping the value to $330,000, a 34% hit. Why the higher rate? It reflects risks like revenue loss or a prolonged ramp-up. In many cases, like a forced move, goodwill might be near zero. You'll need robust pro forma projections, validated by a business plan, market research, and franchisor data, to trust those earnings. The direct market data method offers another lens, using price-to-revenue multiples from comparable sales. Stable restaurants might sell at 0.5 times revenue, but relocated ones drop to 0.25 times, reflecting buyer caution. So a $1 million revenue restaurant could fall from $500,000 to $250,000 post-move. Many appraisers consider the risks of relocating too high and rely on the asset approach. In essence, the value is simply the fair market value of the furniture, fixtures, and equipment, along with inventory and any other tangible assets. There is no goodwill. It's been eroded by the risks of the move. Conceptually, this makes sense. A restaurant that is starting over in a new location with new customers hasn't created any goodwill because it hasn't demonstrated cash flow generation in the new location. Historical financials? Don't rely on them. A restaurant's past success near an office district won't hold in a residential area, as location drives most revenue. Transition costs or closure spikes distort recent numbers. If there are reliable projections, focus on projections with sensitivity analyses, say plus or minus 20% revenue, to test repayment strength. Post-COVID trends make this trickier. Delivery, now 15 to 25% of revenue, can collapse if the new site's radius cuts out prior customers. Labor shortages bump training costs by 8 to 12%. All of this points to what is intuitive. Relocation still strains recovery. Check borrowers' delivery logistics and staffing plans closely. What can you do as lenders? First, scrutinize projections and collateral. Require traffic studies, demographic data, and a business plan to confirm viability. Short leases or zoning issues are red flags. Second, stress test cash flows for a 6 to 18 month recovery. If the restaurant stabilizes, its value can rebound, but until then, caution is key. In closing, relocating a restaurant is a high-stakes move that depresses valuation and raises default risk. Until that new location proves itself, caution isn't just advisable, it's essential. Valuation is a moving target, and so is the restaurant. Thanks for joining us for this episode of the Valuation Desk. When you need clarity, confidence, and credibility, experience makes all the difference. At Highland Global, every appraisal is backed by decades of expertise and thousands of completed reports. We don't just crunch numbers, we provide insight, context, and defensible conclusions that lenders can count on. Whether it's a business acquisition or equipment appraisal, our seasoned approach helps ensure your deal moves forward with precision and trust. For more information on valuation-related topics, be sure to visit our website highlandglobal.com. Lenders know experience matters most.